you, that's a breakaway gap. Why? Why should that be a breakaway gap? Because we are under time distortion. That means all of this back and forth price action is just marking time. That's the benefit of knowing how to use a time-based chart. I'm waiting for time. When does it start? Right there, 2 o'clock in the afternoon, New York local time, because the market is driven by an algorithm. There's a time for everything, a beginning and an end, a pause, a consolidation, and distortion, where everything you try to do will chop you up. So you wait for what? 2 o'clock, and then wait for displacement. What does that look like? Right here, takes out that short-term low, boom. But now we have what? We're late in the day. This shaded area here is the buy side and balance, sell side efficiency. We have moved away from the high, and we moved aggressively away from the 75%, upper 75% range of this shaded area. So I don't want to see this area come back into. I don't want to see it come back up and trade into that. But if it does, I would treat it as an institutional order flow entry drill. In other words, a partial entry and then sell off. Either way, it makes it a breakaway gap. So we don't want to see it trade back up above 50% or consequent encroachment of this shaded area here. And now we enter into another time of day, the 250 to 310 macro. My algorithm starts at 250 to 310 and will start spooling price running for the liquidity that has not been purged yet. What is that liquidity? The liquidity below the lows. The 7 a.m. New York session time, the 8:30 lows, the 9:30 to 11 lows, all of that is the draw on liquidity. And or, in this case, 20% of the weekly range. That would be anywhere in this area here. But we start to see this energetic price run, aggressive dropping lower. That's algorithmic. This right here, just like I talked about earlier, when we ran up, you can use the fair value gap on the left side of the curve. And we're seeing that happen right there. Then it breaks. This is a measuring gap. We don't want to see that filled in, just like we don't want to see that. What makes this a measuring gap? Well, between this high down to this low, we're expecting that run. And about halfway, we're expecting a gap to form. When it does, and it moves away from it, we are not expecting it to come back into that. That's a measuring gap. You have to know where the market's likely to draw to. Breakaway gaps are just gaps when you want to see an energetic price run away from an area you anticipated prior to it running away. So you're expecting it to move lower? Great. When it finally does and it creates a gap like this, your first thought should be, okay, the first fair value gap after it starts to run, that should be a breakaway gap. We want to see that, especially if we've been in consolidation or experiencing time distortion. Time distortion is simply a matter of time between segments of time of the day where markets will start spooling. That's it.